So good afternoon again. Thanks again, Susie, for the nice invitation. Thanks for your perseverance in still being in the room. In my country, Belgium, you start with, well, not so famous singers, and then you keep the start to the end. So I'm very happy to see that the room is still very well filled because we already had the Madonna of state aid, unfortunately. What I will be talking about, and maybe Susie, it's a bit too much honor to say the taxpayer view, it's just a view of a one-trick pony in transfer pricing. That's the only thing I'm doing. But I'm doing that since a long time. And I would like to make a few links to what I said to Mrs. Vestager. I know I pronounce it completely wrong. In a Danish environment in Brussels, everybody says Vestager, but you say, whoa, I don't even dare to repeat it. So what am I going to talk about? And Susie, you said I had a bit over 30 minutes. Good. The very essence of state aid rules. I'm going to talk a bit about our post-neoliberal world we're living in. I'm going to talk about economic rent. Why am I going to do that? Particularly for the transfer pricing / international tax practitioners, we have that concept of value creation post-BEPS that we are grappling with, and sometimes it is tough to do that. I'm going to talk about how governments grab some of the economic rent, and they should do that, obviously, for very good reasons. And then I'm going to talk about global mobility. And for those who were here when I was asking the question to the commissioner, what's the risk of global mobility becoming the next big thing in state aid? So are there a few opportunities, maybe ideas to think about to fuel remote working better? And maybe that could be best solved by putting together a group of people, representatives of the government, DJ competition, but also DJ tax UD, the tax unit, representatives of civil society, representatives of the corporate environment, and so on. So that's my call for action. And then I think you must all have fallen asleep by then, or have left the room. So I hope you're brave enough to go through it together with me. So the very essence of state aid rules, and I would like to go back to a couple of things that the commissioner was saying. We're talking about taking away distortions of free movement, enhancing the competitiveness of the EU, because countries outcompeting each other, it's not a good thing. And I think the externalities that the commissioner was referring to are illustrating things. Negative externalities. There is not a single member state that prices negative externalities, this sort of tit-for-tat strategies. But actually, it should be something where we internalize that sort of thing. So where are we now today? And when we are assessing this landscape, well, is the focus really on taking away the distortions, or is the focus on raising revenue? Because when you listen in to gatherings of the European Parliament, the Fisc Committee of European Parliament, and I do understand the political capital that can be built based on that. I do understand that. But are we really talking about the distortions, how to take them away, or how to raise income? And state aid, as I was saying during the panel, for me, it has become something like punitive, whereas it should be, as a European, we should say it's a good thing to have state aid rules for all the good reasons that Professor Mason was also already bringing to the table. And obviously the fairness debate, we are aware of that, we do appreciate that, but we do appreciate what the OECD / G20 is doing on that front. So I won't talk about that today. So, and then the last bullet there, well, the first wave of state aid cases, these transfer pricing state aid cases, they stemmed from these sort of streamlined models, streamlined business models. In the era of hyper-globalization, you can streamline your business model, and then it might be difficult or sometimes easy to make use of some loopholes. And I deliberately now echo what the commissioner was saying. But for the diehards in the room, if you by coincidence read The Economist of this week, there is an article in it about how multipolar multinationals have become these days. So, and maybe the next big thing might be state aid cases around something for which we are extremely good in Europe. We don't have lithium, we don't have cobalt, we don't have nickel, we have brain power. We have so many good people, and you see already those countries who are accommodating these very, very mobile people might be the winners. And maybe what those countries are granting might qualify as state aid, maybe not. But that's the reason why I think it would be good to discuss that already up front. So the proliferation of brain power and how to accommodate that, because this value creation concept in the OECD guidelines is somewhat, well, can I say nebulous? It might mean different things to different people. Economic substance, it is not legally defined. Value creation is used as a proxy, and it may mean different things to different people. So that's what I'm going to talk about for the remainder of my time. We have to think about fueling free movement. We have to think about combating distortions. We have to think about a new way to identify state aid, and I'm using wording of Professor Mason here. Time to engage upfront rather than having surprises 20, 30 years after certain structures have been set up. And this is something that we need to do in an inclusive way. So the post-neoliberal world, and I deliberately have here on my slides a reference to a book you may be familiar with, maybe not. It's called The Company. It's called A Short History of a Revolutionary Idea. The book is 20 years old, and you should read it through the lens of today. It's only 120 pages, so it reads very quickly. But what was this about? This went back to thousands of years before Christ, how the joint stock company was actually created, how we know it today. Talks about the East Indian Company and these sorts of things. But basically what it was about was that one of the best ways to fuel growth is by a company. So you may like or dislike multinational enterprises, but they can be there for the good of people. I don't want to preach here, but already in that book 20 years ago, there was a mentioning that companies have to secure a franchise from society. So we should not say that everything is about legality and that we should set aside legitimacy. That's not what the book was saying. But the book, the authors, and these were two, I think, economist journalists, was saying, well, do we need more supervision? Do we need more regulation? Do we need more strict rules for companies to obey? Or should we lessen that a bit? Because at the end of the day, companies have to think about legitimacy. If you want to attract good people, you have to think about your corporate values. And this is something that I brought deliberately in the conversation, because if we take now a new book, and that's something that came out, I think, last year, this book of Mrs. Vohra, she's a journalist of the Financial Times, and she talks about a new form of globalization. She says, the invisible hand may not have done its work properly at all times. Days of hyper-globalization are maybe over, but we're going to see a different sort of globalization. Companies, and this is where you can make the link with the Economist article on the multipolar company. So we are living in a world where we see maybe more regional forms of IP creation. So when I read it as an EU citizen, I read this book as something like, we have to work better at making this EU bloc functioning very well. So these books have nothing to do with taxes, and that's probably the reason why they are not dull or boring at all. So economic rent, I don't need to go in much more detail about this. This is just depicting the geopolitical situation that companies are facing these days. We have technology that enables us to make the value chain shorter and more easy to manage. But on the other hand, there are the geopolitical tensions that provoke certain, tendencies of protectionism and the like. So this is something we have to factor in. And this is something where the legislator also need to understand that you cannot change a business model overnight, let alone your transfer pricing model. If you talk corporate strategy, and I don't know how to do that, but if I listen to what the C-suite is doing, what senior executives have to grapple with, it takes time to adapt your business model with all the legal boundaries, equally opportunities, and then we have to design a tax framework that fits it. So now comes a bit my area of expertise. Are the current transfer pricing rules fit for purpose? Because if I read the state aid cases, I have the impression that the whole problem is about, well, it's comparable to a lollipop, because you have a stick and you have the lolly. And these one-sided transfer pricing methods was like, hey, tax authority, this is my TNMM result, transactional net margin. This is the 2 or 3% EBIT that this country is getting, and that the rest, the remainder of the system profit throughout the value chain, that's not your business. You shouldn't ask questions about it. And that's exactly what is possible, and what definitely was possible under the OECD transfer pricing guidelines that existed when most of these state aid cases saw their genesis. So it is perfectly possible under the 95 OECD transfer pricing guidelines to have residual profit that remains untaxed. So, but where are we now? Post-BEPS, if I can use that word. We meanwhile had the updates of the OECD guidelines. We had the 2017 guidelines and later on with more guidance on profit methods and the like. So isn't it so that we have to ask questions about value creation, not from a sort of tick the box perspective, functions, assets, risk, but more like the non-tax world would look at it? How do you win in the market? How do you create value? How do you leverage technology and things like that? Because at the end of the day, business models are constantly unwound, reassembled, and so on. And this is where the tax practitioner needs to ask companies how they deal with it and what it means from a value creation perspective. Easier said than done. So the tick the box sort of transfer pricing analysis is probably something of the past. And now we're more talking about assessing key value drivers. I think when you listen to what Professor Mason is saying about these old state aid cases, it was in an era that nobody really asked the question about this value creation. And when I was at the General Court hearings in the Apple case, I think it was in 2019, and I don't want to be cynical, but one of the lawyers was making the point, do you really believe that somebody who wants to buy an iPhone takes into account how good the after-sales service in Ireland is? So you buy an iPhone because you hope it breaks down, and you hope you can go to the Irish branch to ask for another one or for a repair of it. No, the brand equity and the residual profit sort of generators, they probably sit elsewhere. So maybe we have to forget about these old cases, and I do understand legalistically that's not possible. But when you look at state aid, you should probably today look at the lens, at the future lens. And this is the reason why I will touch on working away from home in a couple of minutes. So what options do governments have to take economic rent or part of the economic rent, to tax economic rent? Obviously, tax measures, antitrust policy, but also tariffs and other means. And it's easier to do that for resident companies than for non-resident companies, because this is my example of the lolly stick. Sometimes it is hard to tax a non-resident entity. Is there a permanent establishment? Is there a taxable presence at all? And if there is a taxable presence, can I claim more than what I could claim under a one-sided method, like a transactional net margin method? And I invite you to, and I think, Susie, you will share the slides. This reference is to a academic work from a couple of people like Mitchell Kane, Professor Bankman, and a few others that goes very much into this sort of economic rent analysis. So food for thought. So what options do we have in taxing economic rent? So tax and state aid. And now I'm making a few points why it's so important to have international cooperation. And we cannot engage in crafting good rules, I mean, we, the tax legislators, without that international cooperation. I don't know whether this is what the inclusive framework is fully successful in when we look at global tax reform, but at least you need this international cooperation. Because multinationals, well, they create economic rent based on the intangibles they're creating, based on the brain power from the various people. Jurisdictions, well, they will try to capture some of the economic rent, but it depends on the sort of monopsonistic market power that countries have. Now you are saying, oh my goodness, now I'm getting a headache. What the hell is that? Well, the monopsonistic power has to do with, can I get in another country what I get in country A? And shouldn't I go to the other country? And that's maybe a bit that drives the mindset of state aid commissioners. And I won't go naming the name because I don't dare to pronounce it in Danish. And then you have the consumers. And with all the plans we now see on the green and clean agenda, well, the consumers at the end of the day should not risk to pay higher prices if countries have a political incentive to go after the rents that aren't felt legitimate. So there is a bit of an issue here that countries may say, I want to tax more. They seek for national welfare, but the national welfare may or may not be aligned with global welfare, and it risks not to be aligned with it. And this is where this problem of the negative externalities stems from. So, is industrial policy a good idea? We all heard the commissioner saying, well, the political world is intervening because we have no time to lose. There is this sense of urgency. I'm a reader of The Economist, as you already heard, because then I can look, well, I mean, a bit more smart than as a stupid transfer pricing consultant. So is industrial policy a good idea? There is some negative press in The Economist, particularly on the impact of IRA for Europe. And the question is raised, will that money be spent efficiently? Will this not create a sort of zero-sum game where at the end of the day, the consumer is the victim? So how much solar panels does the world need? And are we going to have continuously have Chinese solar panels? We're going to have American solar panels. We're going to have European solar panels. We're going to have extragalactic solar panels, but where does it end at the end of the day? Do we need all that? And I don't want to be cynical, because what these articles are saying is definitely that there is some action that needs to be taken. But there is also the warning that replicating the Inflation Reduction Act would be unthinkable in Europe. Because, as you see there at the bottom, the EU may see itself as an ever closer union, but taxes are still a national affair, which rules out continent-wide tax incentives. And I think that's also what the commissioner was saying. There is no such thing as a harmonized corporate tax system. So, the temporary crisis and transition framework, we heard the commissioner talking about that. Well, it is a noble cause, and there is a sense of urgency, and the policy objective is clear, but there are a few worrying elements in it. And you may have seen this matching aid clause. So, in other words, when a European company would get a certain subsidy under the IRA in the US, well, it might very well be that under specific conditions, that company might also knock at the door in Europe to say, match this aid. And they could match it, provided it would benefit, I think, 3 member states and 1 sort of deprived economic zone. But this is something where you might think, well, isn't that matching aid clause, I don't want to be negative, but isn't that adding to the sort of concerns about the zero-sum game? And these are 2 Belgian professors. So Professor De Vos is saying, well, we should be competitive with the US. So it is not something where we have to work on negative externalities, but we have to create a climate for innovation. And if the climate for innovation in the US will be better than in Europe, they will win, and they will have a right to win. The other professor here, Renilde Veugelers, also from Belgium, she's from the Louvain University. She is saying, well, we have to avoid subsidy wars. Of course, she's not the only one who would say that. But fragmented internal markets are bad for startup companies. Industrial policy is risky because the risk of government failure exceeds the risk of market failure. So, and maybe rather than doing the sort of solar panel thing, and sorry, I don't want to be, I'm not making political statements here, but rather purely technical, these professors are saying, shouldn't we think about creating synthetic alternatives for critical components like these rare earths? Maybe we can find a synthetic alternative for lithium. And shouldn't we invest in that sort of innovation in Europe? So these are all, I think, very much interesting and critical observations by very smart people on trying to see where IRA and EU state aid measures can be married. Now I'm coming to the final point. Fueling the mobility of brain power. So what I mean by that is, as a tax consultant serving predominantly multinational enterprises, we see that working from anywhere is a big thing. It's on the agenda of almost every company these days. And it goes from companies on the left side who are saying, well, we have a policy of working 20 days maybe from wherever you want, to companies who are saying, well, we have already set up a whole environment to make sure that people can work from wherever they want. And you see that little bulb there. Most companies are evaluating what to do these days because nobody wants to miss the possibility to hire a tremendously smart and promising young person. You don't want to miss out on the brain power. You want to accommodate them, but you risk to have a few tax problems for that. What are the risks? And here I must say, and I do appreciate that the commissioner is less in day-to-day taxes as people like ourselves are, but she mentioned that personal income tax is not a state aid issue. I appreciate that. But what about the permanent establishment problems? So am I not creating value outside my employer's jurisdiction if I'm working from home? And during the health crisis, this was plausible. You had the VP marketing of a company that was headquartered in France. The VP marketing was a German individual. There was guidance from the OECD that was okay. I'm making a shortcut here. But we are no longer in this health crisis. We are now in a situation where people are leveraging more and more the opportunities that technology is offering to work from wherever they want. So what about these payroll problems? What about labor law problems? What about indirect taxes? Am I rendering services from one company to another? And getting it wrong will create reputational damage for companies. Getting it right will mean attracting even more brain power. So maybe a few ideas here where one could start from the fact, are tax treaty rules still fit for purpose? So, well, Article 15, is this 183-day rule still fit for purpose? This is a very slippery slope for me. I'm a transfer pricing person, but 183 is half of a calendar year. So it takes into account professional days, but also your private days that you're spending. So maybe this is something where we can make it 110 days, half of 220, which are the average working days. So is there something to think about harmonization of those thresholds better? And then the other one, the Article 5 one, well, there is no clear guidance to determine whether the use of a home office is sufficiently permanent. There is a lot of interesting stuff on working from home. And quite some commentators are saying, academics, how can my home office be at the disposal of my employer? When my employer knocks on the door, I kick him or her out. Well, maybe it's true. And maybe that's very much true when you read how Article 5 today works. But isn't that something where we have to think about how these concepts might evolve in a not too distant future? Don't we need to think about some safe harbors maybe and have some other rules in place or some nuanced rules in place? At least let's have a discussion on that. Maybe we have to look, and that's what we are doing already for quite some multinationals. We look at the level of concentration of key decision makers. What I mean by that is, what if imagine you're a Danish multinational and you have people, very senior people. So Susie is your chief marketing officer, but Susie, she wants to ride her bicycle and she absolutely wants to take the little hills we have in Belgium. And she is going to work from Belgium. But, well, she's going to do that maybe a couple of weeks a year, the only weeks that we have good weather, so it can't be much. But then the question is that really a problem for the brand equity sort of preservation and the tax preservation of the income of the trademarks in Denmark? Maybe, but maybe not. But what if Susie brings her whole team to Belgium? Then we have a concentration of people in the value creation. And then it may be a bit too easy to say, it's Susie, very senior, but the team of people, more preparatory or auxiliary people. So it's not a big problem. It may be a problem. And maybe there are some standards we can leverage, like we are using, for instance, something that is known in macroeconomics, the Hirschman-Herfindahl index. It measures industry concentration, but you can adopt the same principles to these sorts of situations. What does it mean for my value creation if I have dispersed teams of people in several countries? Maybe we can have this sort of discussion also as part of a broader forum, because then we are doing a very comprehensive analysis of what value creation means. I can assess better where my significant people functions are. How do they relate to other significant people functions? I deliberately use this notion because I'm talking about permanent establishment exposure here. And this is also something where I can bring in, or where I can appreciate the pressure on the one-sided transfer pricing methods. Because we should not forget that in chapter 3 of the OECD guidelines, there is also an obligation to make a qualitative assessment of the non-tested party. So the more complex party, well, needs to be described. You don't need to test the profit level indicator. You don't need to test against what the profits are benchmarked, because then we would be in a default profit split. That's not what the guidelines are saying, but the guidelines are saying, don't limit yourself to the stick, but also describe how the lolly is created. So this is something to think about. So very quickly, what sort of ideas are there? I already touched on Article 15 of the treaty. Should we think about a revision of the 183 days? Well, should we? I mean, this is something the legislator may think about, and I do appreciate how tough it is to make treaty changes, but isn't it time to create a forum for discussion on that? Should we think of the genesis of a permanent establishment? Should we think deeper on all those things? And when we bring the discussion again to Article 15, well, I am taxed where I live, but I can be taxed where I work. If there is a charge, even if I work one day in another country, if the charge is then with that country where I am exercising my duty, there I am creating a tax liability there. Maybe there is a need or a reason to align that better with how Social Security works. This is something where people at the European Commission are currently thinking of. What are the most pressing needs? What are the most pressing hurdles to overcome to avoid that we get a sort of a cacophony of various rules to apply in different countries? And then, so the final one, and here I should have Article 5 on the top of the slide. So, but I'm a very lazy preparer of slides, so I did cutting and pasting. Today, Article 5, one of the model OECD. So the permanent establishment description, well, is a fixed place of business through which the business of an enterprise is wholly or partly carried on. We have then the dependent agency provision, and this is something where I should also bring in the fact that post BEPS 1.0, if I can use that word, we have a bit of an additional complication by the sheer fact that not all countries have signed a multilateral convention. I coincidentally look in the eyes of Professor Mason, but for the rest, it has no reason. But there you see that there are different interpretations of Article 5 based on the multilateral convention. So maybe we have to talk more, taxpayers, tax authorities, civil society. And I think, Susie, this is where the academic world can play a very important role. Maybe we should exclude voluntary work outside the employer jurisdiction. This is like cursing in a church for a transfer pricing practitioner, because we have to think about this value creation notion. So maybe we have to think of excluding certain people. Maybe we have to make the link to the auxiliary and preparatory notion. Maybe we can bring in the sort of concentration indexes we can do all sorts of things, but we have to keep in mind Article 7. There is a tipping point where we need to think about how to allocate profits as soon as we do have an Article 5. So is this a plea for the abolishment of the tax treaties whatsoever? No. Who would I be to even dare to say that? But the call for action is a call for action that I also mentioned to the commissioner, and where she said during the break that it was a good idea. That's why I'm not a politician, I think, and she is, but good to hear that there is an important role for multi-stakeholder engagement. Working from anywhere, it might be a next big thing, and we should make sure that we can fuel global mobility to the best we can, because our EU brainpower is, I guess, the only primary good that we have in abundance in Europe. The OECD is in charge of the working from anywhere track, but there is an important role also for the European Commission. Maybe a forum in the line of what we had in the context of the EU Joint Transfer Pricing Forum might be a good idea. Unfortunately, that was abolished. And recently at a conference at Vienna University, Mr. Biebel from the Commission said that was a political discussion, that was a political decision, because we do appreciate how international dialogue can get us to good sort of thinking about where the legislator could go at. Otherwise, we wouldn't have had the low value adding services guidance in the guidelines. We wouldn't have had EU transfer pricing documentation. We probably would have needed more time to land on Action 13 of BEPS on documentation and compliance. And maybe this is something where if we would have such a forum, we could do some viability testing. There are multinationals out there. There are taxpayers out there. There are tax administrations out there who want to spend time in working on a pilot to exchange and to bring these sorts of ideas to the legislator. And that would, and I end with a critical note, that would be such a much better world than a world where you are confronted in 2014 with tax structures our parents, grandparents might have set up in the 80s and the 90s. So with this, I see you're still very much awake. I would like to thank you. Thanks again for having had me here, and very happy to take questions.
Hey, I'll come join you on the stage, Isabel. Thank you very much for this very enlightening presentation. It's always good to hear from the practical point of view. I'm going to allow myself the first question. So if you had some advice for the Commission, so let's say they were able to have a do-over in some of the state aid cases for the future, what would you tell them to do differently as a practitioner?
Whoa. And
I know it's a tough one, but you
think,
get drinks afterwards.
Yeah, but I think you you promised Mrs. Vestager the link to the presentation.
Yes. Now's your chance.
What and that, Ruth, I don't want to bring Professor Mason in discussion, but I'm going to try it anyway. When I read the cases from the start, it looks as if double non-taxation was like the big culprit. If there was double non-taxation, we had to go after it. Whereas it could have probably been better to start from the basics of the international tax rules. And this is why I also referred deliberately to the OECD guidelines of 95. If you want to bring certain guidance, if you want to bring that in the equation, you probably had to start there. But who am I to say that those people did the wrong thing? But I think the double non-taxation got so much priority, whereas the biggest problem we have are still double taxation, I think, rather than double non-taxation. So that's for me the thing where they could have done it differently.
Would you like to comment? Mm-hmm.
Just staying on theme here, in the United States, the US Supreme Court has made it completely abundantly clear that neither double non-taxation nor double taxation is the problem that our anti-discrimination principle is dealing with. You only care about double taxation to the extent that it's discriminatory, you would say selective, for state aid. And the fact that there may be gaps or overlaps in tax is a pure function and an inevitable result of each member state retaining the authority and the power to define its own base. And as long as you keep that, and that's in the treaty until they amend it or change to a common base under Article 115 by unanimous vote, there will be gaps and overlaps. There will be double tax, there will be double non-tax.
And maybe, Susie, if I may
Mm-hmm.
add, I am a Belgian, as you know. There is always this recurring, and this is a bit technical, but the recurring reference to the Belgian Coordination Center case. Like, this was the precedent. But the Belgian Coordination Center case, I don't want to bother you with the details, but that was a special regime that was granted to multinationals who had some important people in Belgium, but who did not have direct client contact in the context of making sales. So these were very important people, but cost plus type of people. And this was something where, well, very important people, cost plus people. I see some people in the room laughing. I hope you're not a CEO. But this regime, well, the cost plus did not apply to personnel expenses. This was the only value at cost that there were, because it was a coordination center that was hosting these important people. So this sort of precedence the use of the Belgian Coordination Center. And I see this now all over again and again and again, now that the excess profits ruling cases are for the general court. I see this again and again in what is ahead of us, because we're going to have an interesting case on the 23rd of May in Luxembourg as well. So this reference, I'm not sure whether, well, I found it unfortunate. It should have been looked at through a clear technical transfer pricing lens already years before.